The most often used indicator to measure inflation is the Consumer Price Index. Now, the CPI tracks the average price of goods and services in a representative household basket, weighted by how much is spent on them. Now, if the CPI rises, then it means that the prices of goods and services within that basket has risen. Now, sometimes economists prefer to refer to core CPI, which is the CPI without food and energy prices, because they tend to be more volatile month on month, so as to get a better gauge of average price levels. So why is inflation so high today? Well, American economist Milton Friedman most famously claimed that inflation is always and everywhere a monetary phenomenon. Basically, he's saying too much money chasing too few goods. Now, David Moss of the Harvard Business School lays out in his book on macroeconomics that it's down to a combination of three factors. Output, how much an economy produces. Money, how much currency is in circulation. And expectations, now what people think will happen next. So on the production side, a few notable things happened last year. Lingering supply chain disruptions caused by COVID-19 and then the supply shock of Russia's invasion of Ukraine were a perfect recipe for soaring prices of food and energy, both crude oil and natural gas. Now, fuel and food costs combined typically account for more than half of price rises. Supply shocks can have the added impact of lowering an economy's output, and that also drives up prices. An increase in money supply can also fuel demand. That can drive up prices too, if output can't keep up with demand. And that was the case over the period of the pandemic, when many central banks held interest rates at ultra-low levels and engaged in massive bond buying programs. Now, excessive stimulus from governments to mitigate the impact of the pandemic and COVID handouts to citizens in 2022 also helped stoke demand. And then finally, a wage price spiral kicks in. People's expectations of inflation rise, leading workers and companies to demand higher wages, and that sets higher prices. What's to be done to manage inflation? Well, central banks use interest rates and other monetary policy tools to control demand and inflation. Tighter monetary policy raises interest rates and therefore makes borrowing less attractive, and that leads to a decline in demand for goods and investments. Households and companies are then too frightened to ask for higher wages or expect their customers to accept higher prices. The forecast is looking good that inflation will be brought to heel this year. The U.S. Federal Reserve expects inflation to have peaked in 2022, while many central banks in Asia have also projected an end to interest rate hikes in 2023. Prices of many consumer goods have already started to decline, with supply chains returning to normal. The cost of oil has also fallen back to its level a year ago, in part thanks to a recovery in production. For CNA Explains, I'm Roland Lim.